Hello, Oracles. My goodness, Tesla. 12 green days in a row. That is an all time record. Thinking back to all the huge runs that we have gone on, Tesla's never been green more than 11 days in a row. And here we are breaking that record today. So, what can we see with Tesla stock going forward? What else is going on in the macro environment? Lots of news to talk about this week. We will get into all of that in just a minute. All right, so looking at the charts, and I apologize, my Weeble is not working, so I'm using my TD account here. But looking at the charts here, 12 days in a row that we have been green, closing just under $250. What an amazing run we've been on. Obviously, we've been enjoying this run, coming up all the way from $100. People hanging in there, doing great. We had a couple of dips along the way. And again, looking at the way we have been running, kind of leads me to believe that we are actually going to be getting ourselves to, this reverse dead cat bounce that we've got going on. Now, we're going to get into the macro in a minute because we are still macro driven at the moment. Despite the fact that we've got a lot of good news, a lot of good things coming in for Tesla that are helping move the stock forward. Realistically, it is still very macro driven at the moment. So, with the macro stuff we have going on this week, which is quite a bit, there's a potential that we could see some uncertainty coming out of this. We have a lot of different talks on both sides of the thing of, everybody's saying it's overbought. Well, what's going on? We've got an RSI pushing close to 90 at the moment, which is extremely high and very overbought. Again, Tesla's never been on a run that's more than 11 days. We're now at 12. So I keep saying we're due for a pullback, and I think we are. This week we have quad witching that's going on Friday. So a lot of options are closing that day. There's a lot of potential that there could be a big sell-off and a short squeeze going into that day. We've got CPI tomorrow. We've got PPI on Wednesday. We've got the FOMC meeting going on the next 2 days. We've got the Fed coming out on Wednesday speaking, potentially raising interest rates. Don't know. The market is pricing in no interest rate hikes. But if the Fed comes out and says they're going to do a 25 basis point hike, you can bet for sure we're going to see a massive sell-off going on. So market-wide, there's a lot of excitement. There's a lot of FOMO going in right now. So, looking at other indices, we're at extreme greed moment right now. And, we'll go back to what Warren Buffett says, which is be fearful when others are greedy and greedy when others are fearful. If everyone is being greedy right now, these are the times to be fearful. Not so much being fearful, but just take a step back, take your emotions out of it, and realize that realistically, the market can't always go up every single day. It's going to pull back at some point. So you have to take a step back and assess this and say, all right, those of you who are long-term shareholders, none of this means anything because you're looking at the fundamentals, which we've gotten a lot of phenomenal news from that. We have a lot of analysts raising price targets, which aren't as much of a fundamental piece, but that's still a piece that's going to play into the stock price. But we have things going on like, GM and Ford coming out saying that they're going to be using the NACS. We've got Blink Charging saying that they're going to be doing the same thing. Tesla has basically come out and said, in North America, we are going to own charging stations. That's it. You're either going to do it the way we are going to do it, or you're going to go away. And that's really what it comes down to. So fundamentally, that's amazing. So for you long-term shareholders, that's the kind of news we want to hear. When it comes to the stock price and anybody who's short-term or swing traders, we've got those price targets that are going up. We've got a lot of other things that are moving on in the macro that are going to sway this in a different direction potentially. So we'll go into all of that. Let's take a look right now at what the CPI estimates are. And so I personally like the fact that we are going to be getting the CPI and PPI at the exact same time that the FOMC meeting is going on, because this means that the Fed is going to have the most up-to-date lagging information that they can have in order to make their decisions. So looking at the forecast of 4.1%, that's a significant drop when it comes to year-over-year inflation. Now, we have to remember that last year, inflation was still pretty high. This is when it was starting to really go up. So while a 4.1% is nice to look at, and looking at the interest rates, that means that the Fed interest rates will be above this forecast for a year over year. It's still important to look at other pieces of information, like the month over month is going to be more important than the year over year. And so looking at the month over month data, we're looking at a forecast of 0.2%. Now, again, When you annualize that, that is looking at a 2.4%. That there in itself is right in line with basically where the Fed wants to have inflation be at. They want to be right around that 2% level. It's never going to hold there steady, it's always going to fluctuate. But between zero point 0.1 and 0.2% is where they would like to be on a month over month basis. The forecast is for that tomorrow. So we will see what we actually come in at tomorrow, because if we're in line with that, that means that the Fed might actually be confident in pulling off the soft landing that they said that they were going to do. So now the next thing to look at is the core. The core is what the Fed says they actually have control of. Now the core not really coming down much. Last month we were at a 5.5%. Forecast is at a 5.3%. Now the Fed interest rates are not above this number right here, so in looking at it in this direction, the Fed might not be as confident with the interest rates, and they might be going up on 25 basis points to be able to bring it above this. And now when we look at core on a month over month basis, it's staying steady at 0.4%. That has not really changed in the last few months. So 0.4% is still pretty high for a month over month on a core basis. So these are things to really just kind of pay attention to, little different pieces of data to take in, because when the Fed is looking at it, they're looking at a lot of different things. They're looking at this, they're looking at jobs, they're looking at the PCE. All of this different information goes into what the Fed is thinking about when they come to their decisions. So PPI is also important in all of this. That is what is going to be coming out on Wednesday. And so looking at the PPI coming out on Wednesday, we've got a year over year expectation of 1.5%. That is coming down very nicely. These are all of the goods that are being sold to retailers and that of that nature. Basically, manufacturing products going to the people who are selling those products at a 1.5%. That has come down significantly. This has been a leading indicator when it comes to the CPI. Typically, we have seen the PPI moving in a direction, and then the following month, the CPI will follow suit. So, this coming down significantly here is very nice to see. And again, that might be an indicator for the Fed to say, all right, we can go ahead and pause now. And then when we look at the month over month forecast of negative 0.1%, that means that we are coming down. Now, we saw this coming in December as well, but seeing the negative 0.1%, not terrible, but if we see that too many months in a row, that's deflation that's going on, and the Fed is going to want to stop that if that gets out of control. So, in that case, that might be an indicator where the Fed says, you know what, it's time for us to pivot because we need to make sure that we're not spiraling in the wrong direction. So, looking at these numbers here, still we have to go on a month to month basis when it comes to the data. The Fed says it themselves. Just have to keep on looking at the data and making sure that the trends are going in the right direction. We are still moving in the right direction. But when it comes to timing, what we are going to be seeing in the market, as far as are we going to see a pivot soon? Are we going to see a recession? Are we going to see a massive pullback in the market? We still have yet to see the housing market correct. So that is really a big piece that's going on. And one of the things to pay attention to is when the Fed comes out and pauses, a lot of people think, well, the Fed is pausing. Interest rates aren't going up anymore. That means that the market must be okay and we can rally from here. Historically, we do see a rally when it comes to the Fed pausing. However, when you have sustained rates at this level, that for a long period of time is when you start to break things down. Thinking about the fact, like when you're working out, you're holding a plank. Sure, first 10 seconds, not terrible. 20 seconds go by, we can do that. You hit 30, 40, 50 seconds, you hit a minute, it starts to get pretty challenging after a while. That is very similar to what's going to happen when it comes to the interest rates staying as high as they are. Now, over the weekend, my dad made a good point when he was mentioning the fact that, well, these interest rates now are not really all that high, but they're high compared to where we were, which was basically zero. You go from the housing market crash until about 2016, you had basically 8 years of interest rates near zero. Then the Fed started going up on interest rates, and they were pushing up right into COVID. When COVID hit, they brought it down to zero again. Then we had the last 2 years of basically 0% interest rates again. You go prior to that housing market crash, interest rates were around that 6%. I mentioned it the other day when I bought my house back in 2004, we got a 6.25% interest rate on our house. That now is around where we're at. So, you go back to the early 80s and you were looking at 13 to 16% interest rates, and you had about 5% you can get back when you were looking at your bank account savings interest. We're kind of at sort of in the middle of those two places right now. So is that normal? Is that not normal? The Fed doesn't really want to have 0% interest. They kind of want to have the interest be around the same place as inflation. And that's kind of what they want to get it back down to. Again, that 2% inflation and that 2 to 3% interest rate that kind of keeps the market churning and moving forward. That's what they need to get it balanced back down to. So, in this battle going forward, that's why we have to go month to month on this data and see what's going on. And the Fed doesn't want to take the foot off the pedal right now because they're afraid if they do, inflation's going to run. Think about what the market is doing right now. We're taking off. There's still a lot of money in the market. There's a lot of big money institutions that are out there sitting on trillions of dollars of T-bills and bonds. So they are putting money back into the market, but even they're just putting in little bits at a time. They are still anticipating something bigger that's going to be coming down the road when it comes to buying opportunities. And again, this is why I keep on reiterating it seems awesome now. And it is. Don't get me wrong. It's the great times right now. And these are the times where we can really learn to see if we do get into this big recession, if we get into a point where the market has a massive pullback and correction, when you're wondering which stocks are going to do the best coming out of it, look at what stocks are doing the best right now. Tesla, Nvidia, Google, Microsoft, Apple, Amazon. These companies doing extremely well right now are the ones that you want to really pay attention to when we go through the next dip. Now, it always happens. We always get corrections here and there. That's healthy and good for the market. We talk about that all the time. So the big question is, when is it going to happen? And how deep is it going to go? Nobody knows this for sure. There's a lot of different people out there with a lot of different scenarios that they're playing out as to what could potentially happen. I personally think that when it comes to Tesla stock alone, I've mentioned it here many times, filling that 146 gap is almost a given. I do think we're going to fill the 114 gap. At this point, unless the Fed does something major to screw up, I don't think we're going to go any lower than that. But if things get really ugly and they keep interest rates higher than maybe they should, we could go lower. People may call me crazy for that, but again, these are just things that I prepare for. But I'm also prepared for the stock to not come down at all and continue running and us doing a reverse dead cat bounce, the Fed giving us a soft landing, and us running from here. This is why I buy every day. I hedge myself on both sides, and the worst case scenario is for me is we run and I don't get an opportunity to spend the extra cash I've got on the side to buy in at a lower price. No big deal on my side. That's the way I invest, not financial advice. Everyone has their own risk tolerances for this, but that's what I'm doing. In the meantime, I still think there's going to be some great swing opportunities. Looking at a time right now, I'm thinning out of a few positions that I've got because I'm anticipating this pullback. So I can either buy back into those, I can use that money for Tesla, I can save it in cash. Lots of options. I like to have options when it comes to the market because it allows me to be an agile investor. So the one thing I kicked myself for in the past was whenever we got buying opportunities, I never had enough money or any money at all to buy because I was always invested 100% in the market. And the stocks that I was invested in all came down at the same time. So in order for me to free up any cash, I was going to have to take a loss. And I didn't want to do that. So I came up with my strategy. So now I am always ready to take advantage of opportunities. If I see opportunities to sell, I will sell. If I have opportunities to buy, and I don't have anything that I can sell, I've got cash on the sidelines to be able to buy in. It's a strategy I've used for myself. It's worked out very well. If you guys are interested in that, let me know. I can make a video on exactly how I do all of my strategies, but it's made me very happy. And I got to tell you, taking your emotions out of investing is one of the most important things you can do. The moment I did this and made this strategy, my emotions came right out, and it's been absolutely amazing ever since. Couldn't be happier. Never have to worry about myself getting upset in the market, whatever. I don't get FOMO. I don't paper hand. I am good to go. So overall, what an awesome day today for Tesla. We will see how the next 2 days play out. We will see how the rest of this week plays out with quad witching going on Friday. Either way, record-breaking day for Tesla. Awesome. You guys can let me know how you are doing in your portfolios. Many of you sharing how you have been going green recently. That is absolutely awesome to hear. Glad you guys stuck through with it. So if you guys have any questions, throw them down in the comments below. Let me know how you feel about today. Otherwise, thank you so much for your support. Have a great one.